Trump's forced TikTok deal has opened a new front in US-China tensions, and Beijing's reaction is a clear warning. Within hours of the US announcing that TikTok would be shifted under American ownership, China demanded that Washington treat Chinese companies fairly, signaling retaliation if it does not. This is not simply about one social media app. It is about how the world's two largest economies deal with each other, and the risks that ordinary Americans, businesses, and global markets now face. Beijing views the TikTok move as Washington interfering in business for political purposes. That interpretation makes it more than a legal or regulatory action, it makes it a trade weapon. And when trade gets weaponized, both sides have options to escalate. For the US, it was forcing TikTok under American control. For China, the menu of retaliation includes hitting US companies in China, slowing approvals, raising tariffs, launching new investigations, and cutting access to critical resources. The scale of what China could target is massive. Apple earns close to 20% of its global revenue from China, and its supply chain is deeply tied to Chinese factories. Tesla relies heavily on its Shanghai Gigafactory, which produces more than half of its worldwide vehicle output. Qualcomm depends on Chinese smartphone makers as key customers. Nvidia has made billions selling AI chips to China, even with existing US export controls. All of these firms are potential targets if Beijing wants to show that it can hurt American businesses just as much as America can hurt Chinese ones. And China has done this before. It has investigated US companies for antitrust violations, blocked mergers, slowed down imports with new rules, and encouraged its population to boycott American brands. None of this would require a new law or a dramatic announcement. The Chinese government could simply tighten the screws quietly, case by case, until American firms start feeling real financial pain. Another area of vulnerability is resources. China controls the majority of global supply for rare earth minerals, as well as critical materials like gallium and germanium used in advanced chips and electronics. These are not just optional inputs, they are essential for everything from smartphones to electric vehicles to US defense equipment. China has already restricted exports of these minerals in the past when disputes escalated. If it chooses to restrict them again, prices would spike, supply chains would be disrupted, and American manufacturers would have no quick replacement. That kind of move would send shockwaves through Wall Street and Main Street at the same time. The economic stakes go far beyond technology. Agricultural trade is another pressure point. US farmers depend on Chinese purchases of soybeans, corn, beef, and other products. During the last trade war under Trump, China retaliated by slashing its imports of US farm goods, which led to billions in losses and forced Washington to step in with subsidies to keep farmers afloat. If this TikTok dispute expands into broader retaliation, farmers could once again find themselves caught in the middle, paying the price for political conflict thousands of miles away. That makes this warning from Beijing more than symbolic. It is a direct reminder that American workers and industries are exposed if Washington and Beijing decide to escalate. For Trump, the TikTok deal was presented as a win. The message was that America could stand up to China, protect its citizens from Chinese influence, and bring control of a massively popular app under US hands. Politically, that message plays well. But economically, it is risky. China's warning turns the narrative around. If Beijing makes American companies bleed, the perception of victory could vanish overnight. Imagine headlines about Apple losing billions, Tesla shipments stalled, Nvidia blocked from sales, or US farmers watching their exports dry up. That would change the story from "America wins against TikTok" to "America's economy takes the hit from a political gamble." The timing of this conflict makes it even more dangerous. The US economy is already under pressure from inflation, high tariffs, and fragile supply chains. Any new disruption from China could raise consumer prices, slow down manufacturing, and shake investor confidence. Wall Street analysts are already watching closely, with markets moving cautiously as news of Beijing's statement spreads. They know that the TikTok issue could just be the opening move. If Beijing retaliates broadly, the financial impact could be immediate and severe. What this means is simple: TikTok is no longer just a social media story. It is a trigger for the next phase of US-China trade conflict. By warning the US to treat Chinese companies fairly, China is not asking politely, it is threatening consequences. Those consequences could touch tech companies, farmers, manufacturers, and consumers. And because of how deeply integrated the two economies are, escalation will not stay limited to TikTok. Every industry with ties to China could feel the fallout. That is why this story matters far beyond one app. It could set the stage for a new wave of trade battles that reshapes the global economy. China's retaliation is not a distant possibility, it is already taking shape. The clearest sign is the timing of Beijing's actions. Just days before this TikTok dispute exploded, China announced an antitrust investigation into Nvidia, targeting its $6.9 billion Mellanox acquisition from 2019. This was not random. Nvidia is the crown jewel of US artificial intelligence and semiconductor power, and China is showing that it can hit back where it hurts most. By questioning Nvidia's market behavior, Beijing can slow its operations, block sales, and weaken America's dominance in chips. This is exactly how retaliation works, not through dramatic announcements, but through steady, grinding pressure that makes US companies bleed revenue and lose confidence in their ability to operate in China. Next in line could be Apple. The company's supply chain runs through China, and Beijing has a proven history of delaying iPhone approvals, blocking App Store updates, or encouraging patriotic boycotts to signal displeasure. Even a small slowdown in China can cost Apple billions of dollars in lost sales. Tesla is another prime target. Its Shanghai Gigafactory is the company's global lifeline, responsible for producing more than half of its vehicles. If Beijing delays permits, raises labor inspections, or restricts local subsidies, Tesla's entire international output could collapse. Qualcomm, Intel, and other chipmakers that rely on Chinese buyers are also exposed. Every one of these companies is vulnerable to retaliation, and Beijing knows exactly how to exploit that leverage. Agriculture is another front. During the earlier Trump tariffs, China cut back drastically on US soybean and corn purchases, forcing American farmers into heavy losses. If this dispute escalates, China can once again redirect its agricultural imports to Brazil, Argentina, or other suppliers, leaving US farmers struggling. That creates political pressure inside the United States, especially in swing states where farming is central to the economy. Trump can claim victory on TikTok, but if farmers in Iowa or manufacturers in Michigan start losing money because of retaliation, that victory will turn into a political liability. And China knows this. That is why its warning about treating Chinese companies fairly is not just a defensive statement, it is a strategic threat aimed directly at America's political and economic weak spots. Rare earth minerals are an even more powerful card. China controls more than 70% of the world's supply, and these minerals are necessary for everything from smartphones and electric cars to fighter jets and satellites. Restricting these exports would cripple US production across multiple industries. In 2019, during trade tensions, Beijing already hinted at using rare earths as leverage. If it chooses to act now, companies would face skyrocketing costs and long-term shortages. There is no quick alternative supplier. This means Beijing has a direct tool to choke America's manufacturing base at the exact moment the US is trying to strengthen its own supply chains. The most important factor is that China does not need to retaliate in a single move. It can act step by step, targeting one sector at a time, escalating just enough to hurt without closing the door completely. That gradual strategy makes it harder for Washington to respond, while keeping pressure high on American companies and markets. Each action sends a message: the cost of interfering with Chinese businesses will not be paid by politicians, but by American industries and workers. That is why investors are watching closely. Every small regulatory notice in China, every delayed approval, every new export restriction has the potential to trigger market reactions. And all of it connects back to one decision in Washington: forcing control of TikTok away from Beijing. The TikTok dispute and China's warning are not just isolated political moves, they have immediate and serious implications for global markets. Stock investors are already reacting, with tech-heavy indices and companies linked to China showing volatility. Nvidia shares, for example, are sensitive to any news about Chinese restrictions, and Apple, Tesla, and Qualcomm stocks could see sharp swings if Beijing imposes even minor regulatory hurdles. The ripple effects extend beyond the US stock market. Asian markets, European exporters, and commodities tied to trade flows between the US and China are all affected. Container freight rates, already volatile due to past tariffs, could spike if trade barriers tighten or shipments are delayed. That would increase costs for companies shipping goods across the Pacific, ultimately leading to higher prices for consumers in both countries. Consumer prices in the US are also at risk. If China imposes tariffs or export restrictions on critical components, electronics like iPhones, laptops, and EVs could become more expensive. Even everyday goods such as clothing, appliances, and food items imported from China could see price increases. US. Farmers and manufacturers might be forced to absorb costs initially, but those costs almost always trickle down to consumers. Inflation, which has already been a concern, could see a new spike if trade tensions escalate further. That is why this is not just a headline about TikTok, it directly impacts people's wallets and daily life. Global supply chains are another vulnerable area. Many US tech companies rely on Chinese manufacturing, assembly, or raw materials. Delays or restrictions could halt production lines, slow deliveries, and reduce product availability. Tesla vehicles could face delivery delays, Apple products might launch late, and Nvidia chips could see restricted availability. Companies could be forced to scramble for alternative suppliers, which are often more expensive or slower. In essence, every industry connected to China is now under a new risk umbrella. This is where the stakes get truly high. The TikTok deal is a flashpoint that could escalate into broader trade disruption. Analysts warn that even small policy moves in Beijing could ripple across global markets within days. Investors are on edge because uncertainty drives volatility. Companies, meanwhile, must prepare contingency plans for supply chains, costs, and potential revenue loss. Governments, too, are watching, because trade conflicts between the US and China don't just impact companies, they influence diplomatic leverage, foreign policy, and economic stability worldwide. In short, this is not just about social media. TikTok is the trigger that exposes vulnerabilities in markets, supply chains, consumer pricing, and global economic stability. The decisions made over the next few weeks in Washington and Beijing could determine whether this remains a small dispute or becomes a large-scale trade confrontation affecting billions of dollars in commerce. Every shipment, every stock price, every farm sale is now potentially linked to a deal originally about one app. That is why viewers, investors, and policymakers alike are glued to this story. Beyond economics, this TikTok dispute is a direct test of political power and strategic influence between the US and China. For the Trump administration, the deal was meant to show strength, that the United States can force control over a major Chinese tech company operating within its borders. But Beijing's rapid response flips that narrative. China is signaling that it will not accept interference quietly, and it is ready to leverage every tool at its disposal to enforce its demands. This includes antitrust probes, export restrictions, tariffs, and even influence over US companies' operations inside China. Strategically, this is a message not just to Trump, but to any US administration. Chinese businesses and markets will be protected, and interference will have consequences. At the same time, the dispute is being watched closely by other countries. Allies, trade partners, and international investors are assessing how this standoff might affect their own business and diplomatic decisions. If China escalates, it could pressure countries with strong US-China trade links to take sides or rethink policies. Meanwhile, American tech companies are now forced to navigate a highly complex environment, comply with US directives on TikTok and risk Chinese retaliation, or prioritize Chinese operations and risk penalties at home. This creates uncertainty across industries and makes strategic planning for global operations much more difficult. Politically, the stakes are just as high domestically. Farmers, manufacturers, and tech workers could be the unintended casualties of this dispute. If China retaliates economically, it could influence voter sentiment, create pressure on legislators, and complicate upcoming elections. Trump can frame the deal as a win, but every company that loses revenue, every factory that slows production, and every worker who faces uncertainty can turn that victory into criticism. Beijing understands this leverage and is using it as a calculated political tool. Finally, the strategic implications extend beyond immediate trade or revenue. By taking a hard stance, China is showing that it can influence global technology markets, set rules for foreign companies, and assert control over critical resources. This is not just about TikTok. It is about who has the power to shape the rules of global commerce, control information platforms, and determine the flow of technology in the 21st century. The warning from Beijing is both immediate and long-term. Interference will be costly, and the consequences may ripple across multiple sectors for years to come. Every decision Washington makes now will be analyzed, monitored, and responded to by Beijing, setting a precedent for the next wave of US-China interactions. The TikTok dispute is far from over, and the consequences could escalate rapidly. If Beijing decides to retaliate in a targeted way, US tech companies could face revenue losses, supply chain disruptions, and increased operational costs. Investors could see sharp market swings, and consumer prices in electronics, EVs, and imported goods could rise. Farmers could once again lose export markets, repeating the pattern seen during previous trade conflicts. On the other hand, if Washington pushes too aggressively, it risks a broader trade standoff, potentially hitting sectors beyond technology and agriculture, including manufacturing, rare earths, and energy. Analysts warn that even small steps by either side could trigger a chain reaction, turning a single TikTok deal into a full-scale economic confrontation that impacts global markets. At the same time, there is a strategic game being played. The Trump administration can claim a political victory by asserting control over TikTok, but Beijing's warning reminds everyone that leverage is not one-sided. China can escalate quietly, step by step, creating pressure without provoking a headline-grabbing confrontation. This careful escalation is dangerous because it gives Washington limited options: respond and risk further escalation, or back down and lose face politically. Either way, the situation is tense and unpredictable. For ordinary Americans, this means that the effects of the dispute may show up in their daily lives sooner than expected. Electronics could cost more, cars could face delivery delays, and even access to certain apps or platforms might be restricted. For global businesses and investors, the situation requires constant monitoring, as any sudden move by China or the US could immediately affect stock prices, supply chains, and trade flows. The ripple effect is significant because the US and China are deeply intertwined in nearly every sector of the global economy. Looking ahead, the key question is whether this dispute will remain focused on TikTok or expand into a larger trade conflict. If it expands, we could see tariffs, export restrictions, antitrust investigations, and market volatility affecting multiple industries. If it is contained, the warning alone may still change how US companies operate in China, forcing them to adjust strategies, shift supply chains, and reconsider global investments. Either way, this is a pivotal moment in US-China relations, demonstrating how a single tech deal can have far-reaching consequences across trade, politics, and daily life. Ultimately, the TikTok deal is not just a story about an app or a political win. It is a test of power, strategy, and global influence. It shows how quickly economic leverage can turn into political leverage and how decisions made in Washington and Beijing can affect companies, investors, and consumers around the world. The next few weeks will reveal whether this dispute escalates into a broader confrontation or remains a high-stakes negotiation, but one thing is certain: TikTok has become the epicenter of a trade and economic battle with consequences that extend far beyond social media.